If you're living in America and still think investing is only for rich people in suits, you've already been lied to. In 2026, investing is no longer optional. It's survival. Prices are rising, savings are losing value, and working harder alone won't make you wealthy. The real question is, will your money work for you, or will you work forever for money? Let's start simple. A stock means ownership. When you buy a stock, you're buying a small piece of a real company. Companies like Apple, Amazon, Tesla, or Google. If the company grows, your money grows. If it fails, your money drops. That's it. No magic, no gambling, just ownership. Many beginners think the stock market is risky, but here's the truth. Not investing is the biggest risk. Inflation quietly steals your money every year. Keeping cash under a mattress or in a low-interest account means you're falling behind. In 2026, investing has become easier than ever. You don't need thousands of dollars. Many U.S. platforms allow fractional shares, meaning you can invest with as little as $5 or $10. The barrier is no longer money. It is knowledge and discipline. Stocks grow because companies grow. People buy products, companies earn profits, and investors share the rewards. This is how wealth is built in America. Slowly, consistently, and patiently. If you remember one thing from this video, remember this. Stocks are not about getting rich fast. They're about not staying poor forever. How the stock market works. Types of investments, detailed version. Now let's understand how the stock market actually works, because once you understand this, fear disappears. Most beginners think the stock market is controlled by luck, but in reality, it's driven by business performance, human psychology, and time. At its core, the stock market is a marketplace. Companies list their shares so they can raise money to grow. Investors buy those shares hoping the company becomes more valuable in the future. When companies grow profits, expand globally, or innovate, their stock prices usually rise over time. Stock prices move for four main reasons: earnings, news, demand, and emotions. When a company reports strong earnings, investors gain confidence and buy more shares. When bad news hits, fear spreads and prices fall. Smart investors don't react emotionally, they react strategically. Now let's talk about the main types of investments every beginner in 2026 must understand. First, individual stocks. This means buying ownership in a single company. If that company succeeds, your returns can be high. But if the company fails, your investment can drop sharply. This is why individual stocks require research, patience, and risk management. Beginners should never put all their money into one stock, no matter how popular it is. Second, ETFs, also known as exchange-traded funds. ETFs are one of the safest starting points for beginners. Instead of owning one company, an ETF owns dozens or even hundreds of companies at the same time. This spreads risk automatically. In the US, ETFs like the S&P 500 represent America's strongest businesses and have historically grown over long periods of time. This is why many financial experts call ETFs set it and forget it investments. Third, index funds. Index funds are designed for long-term wealth building. They don't try to beat the market, they try to match it. Because of low fees and consistent growth, index funds are often recommended for retirement and beginners. Warren Buffett has repeatedly said that most people are better off investing in index funds than trying to pick winning stocks. Fourth, dividend stocks and dividend ETFs. These investments pay you regularly just for holding them. Dividends can create passive income, especially powerful for long-term investors. In 2026, many Americans use dividend investing to supplement income or reinvest dividends to grow wealth faster. Now here's something beginners must understand clearly. Risk and reward are connected. Higher potential returns usually mean higher volatility. This is why diversification is critical. Spreading money across different sectors and asset types protects you from major losses. A key concept you must remember is market cycles. Markets go up, markets go down. This is normal. Recessions, crashes, and corrections are part of investing. Historically, every major U.S. market crash was followed by recovery and new highs. Investors who stayed invested won, while emotional sellers lost. Here's a powerful slogan to remember. Time in the market beats timing the market. The stock market doesn't reward prediction. It rewards patience, consistency, and belief in long-term growth. Beginner investing strategy for 2026. Now let's talk about strategy, because knowledge without action doesn't build wealth. In 2026, successful investors don't guess, they follow systems. Step 1, define your goal clearly. Ask yourself why you're investing. Is it retirement, financial freedom, buying a home, or creating passive income? Clear goals help you stay calm during market ups and downs. Step 2, separate investing money from survival money. Never invest money you may need in the next 6 months. Your emergency fund protects you from panic selling. Smart investors protect their downside first. Step 3, start small, but start immediately. Many beginners wait for the perfect time. That time never comes. In 2026, even investing $50 or $100 monthly can compound into something powerful over the years. Consistency beats timing every single time. Step 4, automate everything. Automatic investing removes emotions. When markets fall, automation keeps you buying at lower prices. When markets rise, you benefit from growth. This is how disciplined investors win. Step 5, choose simple, boring investments. You don't need complicated strategies. Broad market ETFs, index funds, and stable companies outperform emotional trading in the long run. Boring is reliable, and reliable builds wealth. Step 6, reinvest your earnings. Dividends and gains should be reinvested, especially in the early years. Compounding works best when money stays invested and grows over time. Step 7, stay educated but avoid noise. Learning is powerful, but too much news creates fear. In 2026, social media spreads panic faster than facts. Long-term investors ignore daily drama and focus on long-term fundamentals. Here's a truth most beginners learn late. The stock market rewards discipline, not intelligence. Common mistakes, investor mindset, and final motivation for beginners. Let's talk about the part nobody likes to talk about, mistakes. Because in investing, it's not always about how much you earn, it's about how much you don't lose. Most beginners don't fail because the stock market is bad. They fail because emotions take control. Mistake number 1, trying to get rich overnight. This is the biggest trap in 2026. Social media makes investing look easy. Screenshots, luxury cars, overnight profits. What you don't see are the losses, the stress, and the people who quit silently. Real investing is boring, slow, and powerful. Fast money thinking leads to fast money losses. Mistake number 2, panic selling during market crashes. Markets fall. This is normal. In fact, market crashes are part of the system. Every major crash in U.S. history, whether it was 2008, 2020, or others, was followed by a recovery and new highs. Investors who sold in fear lost money. Investors who stayed calm built wealth. Remember this, you don't lose money until you sell. Mistake number 3, listening to everyone's advice. Friends, social media, news headlines, everyone has an opinion. But most people giving advice are not even successful investors. Mistake number 4, putting all money into one stock or one trend. No matter how strong a company looks, concentration is dangerous for beginners. Diversification is protection. Spreading your money across ETFs, index funds, and multiple companies protects you from life-changing losses. Mistake number 5, ignoring fees and long-term costs. High fees quietly destroy your returns year after year. Now let's talk about something more important than strategy. Mindset. Investing is not about predicting the future. It's about believing in long-term growth. You will see red days. You will see negative headlines. You will feel doubt. That doesn't mean you're failing. That means you're investing. Here's a mindset shift every beginner must make. The stock market is not a casino. It's a wealth-building machine for patient people. Another mistake beginners make is waiting for the perfect moment. Perfect timing does not exist. There will always be fear, uncertainty, and excuses. The people who win are the ones who start imperfectly and stay consistent. In 2026, investing is no longer just about money. It's about freedom. Freedom from paycheck to paycheck living. Freedom from depending on one income. Freedom to choose how you live your life. Let's be real for a moment. Your job pays your bills. But investing builds your future. Workers trade time for money. Investors let money work for them. And no, you don't need to be rich to start. You don't need a finance degree. You don't need insider knowledge. You need discipline. You need patience. You need consistency. Even small investments done consistently can change your life over time. Compounding is slow at first, then suddenly powerful. Most people quit before it works. Here's a hard truth. Most people will never invest seriously, not because they can't, but because they don't believe long enough. In 2026, the biggest divide won't be talent or education. It will be between people who own assets and people who don't. So if you're a beginner watching this, remember this message clearly. Start small, stay consistent, ignore the noise, think long term. Because the best time to invest was yesterday, the second best time is today, and the worst time is never.